Welcome back to The Explainer. So today we're dissecting a seriously fascinating and honestly pretty misunderstood wealth building strategy hidden right there in the US tax code. We're talking about the Backdoor Roth IRA. If you're focused on optimizing your long-term retirement savings and you just want a clear step-by-step breakdown of how this actually works in the real world, minus the confusing jargon, well, you're in exactly the right place. Let's jump right in. Here's a situation that drives so many savers absolutely crazy. You work hard, your income goes up, and boom, suddenly the IRS says, sorry, you earn too much money to contribute to a Roth IRA. They essentially lock you out of one of the absolute best tax-advantaged accounts out there. But as it turns out, there's a completely legal workaround. And no, this isn't some shady loophole. It's a strategy explicitly permitted under current tax law, and the IRS fully acknowledges it. The crazy part? Most tutorials out there teach it completely wrong.
All right, Section 1, the Roth income problem.
So for 2026, the IRS heavily restricts direct Roth IRA contributions based on your modified adjusted gross income, or MAGI. To put some numbers to it, if you're a single filer, your ability to contribute starts phasing out at $153,000, and it vanishes entirely once you hit $168,000. Now, if you're married and filing jointly, that phase-out kicks in at $242,000 and the door slams shut at $252,000. Earn a single dollar above those top numbers, your direct contributions are at absolute zero. But, and this is a massive but, here is the fascinating distinction the IRS makes in its own rulebook. While there is a strict income limit on direct contributions, there is absolutely no income limit on converting money from a traditional IRA into a Roth IRA. Literally none whatsoever. And that single quirky distinction, that is the entire foundation that makes the Backdoor Roth strategy possible in the first place.
Moving right along to Section 2, the two-step workaround.
Let's look at the actual mechanics. Step 1, you make a non-deductible contribution to a traditional IRA. For 2026, that limit sits at $7,500, or $8,600 if you happen to be 50 or older. Anyone with earned income can do this, no matter how much they make. You're using after-tax dollars here, and you are not taking a tax deduction. Okay, then step 2, you just wait. Give it about 2 to 3 business days for those funds to fully settle in your account, and then you log into your brokerage interface and officially convert that traditional IRA into a Roth IRA. Now, pay super close attention to this crucial operational detail. When you deposit that money in step 1, you need to leave it in cash or a standard money market settlement fund. Do not, I repeat, do not invest it yet. Why? Well, because any investment gains that money earns in those couple of days before you convert it, those are going to be taxable. If your money just sits in cash, there are no gains to tax. We want to keep the IRS completely out of this specific transaction. The whole goal is for this to be a perfectly clean, tax-free move. Looking at those 2 steps, you might be sitting there thinking, is it really that simple? And the answer is, yeah, it absolutely is, if you're starting from scratch. But here comes the major complication that almost every other tutorial conveniently forgets to mention. What happens if you already have an old IRA just sitting around? Which brings us to Section 3, the pro-rata tax trap. Under Internal Revenue Code, Section 408D2, the IRS enforces something called the pro-rata rule. Basically, the rule states that the IRS treats all of your traditional, SEP, and simple IRAs as one giant combined pool of money. It's like a big blender. You don't get to cherry pick and tell the IRS, hey, I only want to convert these specific new after-tax dollars I just put in. Nope. Instead, your conversion is taxed proportionally based on the ratio of pre-tax to total money across every single one of those accounts. Let's look at the difference between pulling off a successful move and making a really costly mistake. In scenario A, you have exactly 0 pre-tax IRA balances. Awesome. You contribute your $7,500 in after-tax money, you convert it, and your pre-tax ratio is 0%. It is a clean, 100% tax-free backdoor Roth. But look at scenario B. Let's say you've got an old 401k rollover sitting in a traditional IRA with $67,500 of pre-tax money. You throw in your new $7,500 contribution. Well, the IRS looks at your new total pool of $75,000. Since that old pre-tax money makes up 90% of the total pool, suddenly 90% of your new conversion is instantly taxable. So the real kicker here is that in scenario B, $6,750 of your conversion gets treated as ordinary income. If you happen to be in the 24% marginal tax bracket, you literally just triggered a surprise tax bill of $1,620 on money you thought you were moving tax-free. And to make matters worse, your after-tax basis basically gets trapped in that old IRA for years. So how do we fix this? Section 4, escaping the trap through the 401k rollover. The solution here is surprisingly elegant. You just need to roll that pre-tax IRA money into your current employer's 401k. First things first, check if your 401k plan actually accepts incoming rollovers. Most do, but definitely not all of them. If they do, roll that pre-tax money right on over into the 401k. You just have to make sure you complete this before December 31st of the year you're doing the backdoor Roth. So, why does this work? It works because the IRS pro-rata rule only looks at traditional, SEP, and simple IRAs. It completely ignores employer plans like 401ks. Once that money is safely tucked away inside the 401k, your IRA balances effectively drop to zero, and you are cleared for a perfectly clean conversion.
All right, on to Section 5, IRS Form 8606 Explained.
I honestly cannot stress this next part enough. If you take literally anything away from this explainer, let it be this unwritten rule inspired directly by the tax code. Without Form 8606, you will pay taxes on money you already paid taxes on. This form is your ultimate proof to the government. You have to file Form 8606 with your tax return every single year you execute a backdoor Roth. It explicitly tells the IRS that your contribution was non-deductible, and it keeps track of your cumulative after-tax basis. If you skip filing this, the IRS is just going to assume the money you contributed was pre-tax, and they will absolutely tax your conversion. If you execute everything correctly and file the form, line 18 should clearly show a taxable amount of zero. Oh, and make sure you keep these forms permanently. They're your proof that these conversions were entirely tax-free.
Moving to Section 6, who should actually do this?
Let's figure out who the ideal candidate actually is. This strategy is perfect for someone who earns above the Roth phase-out limits, currently has 0 pre-tax IRAs, or maybe has a 401k they can easily roll old IRAs into, and has a long time horizon before retirement. On the flip side, though, you should really think twice if you have large pre-tax IRAs that you just can't move, like maybe you're self-employed without a 401k. The pro-rata rule would just make your conversions heavily taxable, and it's not worth it. Also, if you realistically expect to be in a significantly lower tax bracket in retirement, standard tax-deferred accounts might actually still be your best bet for tax diversification. Finally, Section 7. Is it worth the hassle? Let's let the math speak for itself here. If you consistently invest that $7,500 annually at an illustrative 7% return, in 20 years, that grows to over $307,000, all tax-free. Stretch that to 30 years, and it's over $708,000. But get this. If you're a married couple, and you are both executing this strategy every single year for 30 years, that brings you to a staggering $1.4 million. That's over $1.4 million of completely tax-free wealth just sitting right on top of whatever you're already doing in your 401ks. The annual limit might feel a bit small in any single year, but when you zoom out, the compounding effect is just absolutely immense. Let's quickly recap the 3 non-negotiable rules for executing the backdoor Roth without triggering any IRS penalties. Rule number 1, always check your IRA balances first to avoid the pro-rata trap. Clear out that pre-tax money by rolling it over to a 401k. Rule number 2, once you make your non-deductible contribution in cash, convert it to a Roth immediately after those funds settle to avoid any taxable investment gains. And rule number 3, file Form 8606 every single year to officially document your tax-free basis. We've spent a lot of time today talking about protecting your money from taxes while you're saving it up. But what happens on the other end? What happens to that massive 401k you've been building up for decades when the government steps in at age 73 and literally forces you to start taking required minimum distributions, potentially pushing you into a higher tax bracket than you ever even planned for? Well, that forced withdrawal dynamic changes absolutely everything, and it's exactly what we're going to be breaking down in our next explainer. Until then, keep learning, keep organizing, and I'll catch you next time.